This bar chart compares U.S. consumer debt categories. That massive column on the right represents $1.8 trillion in student loan debt. It dwarfs what Americans owe on credit cards and auto loans, sitting second only to mortgages in the entire consumer debt landscape. People usually talk about this topic through a lens of partisan politics, or they focus on the personal responsibility of 18-year-olds making borrowing choices. Neither of those arguments actually explains how we arrived at this number. This crisis is the result of a highly efficient financial machine, a system engineered to allow institutions to extract maximum revenue while bearing zero financial risk. To understand how millions of working Americans ended up holding $1.8 trillion in debt, we have to stop focusing on the borrowers and start following the flow of the money. The federal loan system began with a progressive idea. A college education should be accessible to anyone with ambition, regardless of family wealth. In the late 1950s, the Soviet launch of Sputnik created intense national anxiety that America was falling behind in science and technology. In response, the government passed the National Defense Education Act, creating the first significant federal student loan program. A few years later, Lyndon B. Johnson signed the Higher Education Act. This legislation expanded college financing dramatically by allowing private banks to make loans to students, with the federal government stepping in to guarantee the debt and absorb the risk of default. By completely removing the default risk for lenders, the government intended to build a financial safety net. In practice, this exact mechanism quietly laid the groundwork for a massive financial crisis. The economic engine breaking higher education's pricing structure was first articulated in 1987 by Education Secretary William Bennett. Economists call it the Bennett hypothesis. The logic is simple. If the federal government guarantees that students can borrow whatever amount of money is needed to attend, colleges face absolutely no competitive pressure to keep their prices affordable for unsubsidized families. You can see the result on this line graph. Since 1980, median household income grew by 30 to 40% in real terms. Over that exact same period, average tuition at four-year public universities climbed by more than 300%. As the gap between what college cost and what families could afford exploded, the federal student loan system stepped in to fill the void. Families simply replaced their ability to pay with debt. The availability of federal loans stopped acting as a safety net for the student and mutated into a direct revenue mechanism for the institution. American universities used these new tuition dollars to enter an intense competition for rankings and prestige, specifically chasing metrics set by U.S. News and World Report. Schools funded an aggressive spending spree on new dormitories, athletic complexes, and administration. Between 1993 and 2012, the student population grew by roughly 40%. Over that same time, the number of full-time university administrators exploded by 220%. To maximize their revenue, universities use a process called net price calculation. They take the mandatory financial data families submit on the FAFSA and use it to calibrate their financial aid offers, extracting the absolute maximum financial threshold a specific family can bear. This institutional aid process operates as a sophisticated pricing system, engineered to obscure the true cost of attendance until a student is already emotionally and logistically committed to a specific school. The universities were only one part of the extraction chain. For decades, private middlemen operated under a highly lucrative model where private banks made the loans and collected all the interest, while the federal government absorbed 100% of the default risk. Then there are the student loan servicers, the companies contracted to manage the billing. Because servicers are paid a flat fee per account, they are financially incentivized to keep borrowers in debt for as long as possible. When struggling borrowers called seeking help, servicers frequently pushed them into forbearance. This temporarily paused the payments, but let the interest keep running. Over 12 months, a $30,000 principal remains completely frozen, while thousands of dollars in new debt piles aggressively on top. The most extreme perpetrators were the for-profit colleges. They used aggressive marketing and regulatory loopholes to operate as pure federal aid extraction machines, absorbing billions in loans while leaving their students with high default rates and worthless credentials. Every entity in this chain, colleges, banks, and servicers, was incentivized to maximize extraction, offloading all risk onto teenagers and taxpayers. The $1.8 trillion debt pool exerts a persistent drag on the entire American economy, impacting every sector of national growth. The Federal Reserve Bank of New York estimated that student debt caused a 20% decline in homeownership among younger adults, trapping a massive portion of the millennial generation in rental housing. The fixed monthly obligations of loan service also strip away the risk tolerance and capital required for entrepreneurship, crushing small business formation and forcing borrowers to delay marriage and having children. The burden is also profoundly unequal. Because of systemic wealth gaps, the typical white graduate pays down a meaningful portion of their balance within 5 years. The typical Black graduate, lacking the same intergenerational wealth to fall back on, owes more than they originally borrowed. A federal loan system originally conceived to democratize access to wealth is in practice functioning as a mechanism that aggressively reproduces and amplifies intergenerational inequality. Administrative band-aids have consistently failed. The Public Service Loan Forgiveness Program was built with such intentional complexity by loan servicers that when the first borrowers finally became eligible, the government approved just 96 out of 28,000 applications. The recent political battles over broad debt cancellation, which the Supreme Court ultimately blocked, focused entirely on treating the symptoms of the crisis rather than curing the underlying disease. Fixing the architecture requires addressing the deeply misaligned incentives that created the problem. It requires implementing true skin in the game for these institutions. If the federal government made colleges financially liable for a percentage of their students' loan defaults, those institutions would instantly be forced to control tuition, ensure graduation, and care about the real-world income outcomes of their degrees. The student loan crisis proves a clear economic reality. If you inject massive amounts of capital into a system without requiring risk alignment or accountability from the institutions taking the money, you will inevitably build a machine designed for catastrophic financial extraction.